Hi, everyone. This is Jason Bureka of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I think he's joining us from Lichtenstein. He's a managing director of Incrementum AG. He's an investor and money manager, and he writes the annual In Gold We Trust report. Ronald Stoeferle, thank you for joining me again.
Hi, Jason.
Now, Ronald, I want to ask you about the gold and gold stocks. Why, in your opinion, have gold and gold stocks rallied so much since December?
I think it's a couple of reasons. First of all, we have seen that the amount of bearishness that we have seen regarding gold and especially mining equities at the end of last year was extreme. So everybody was bearish on gold. Everybody was bullish the U.S. economy. Most people thought that the Federal Reserve will do 4 rate hikes in 2016, and I think at the beginning of the year we have seen a classical short squeeze in mining equities, and I think the most important reason why we have really seen the end of the downtrend is that inflation-sensitive assets have basically turned the corner. From my point of view, inflation will become a major topic, and by that I don't mean I don't mean monetary inflation because we're already seeing it. I'm meaning price inflation. I think that the inflation trend has reversed, and therefore all inflation-sensitive assets, commodities, mining stocks, gold especially, will probably continue to perform really well.
Yeah, in 2015, Ronnie, I think we got to that, Sir John Templeton quote where we got to the point of maximum pessimism. Some of these gold mining stocks were down 95% or more. And, people were saying, oh, they're going to go lower. Most of them are going to go to zero. But when we looked in the physical gold market, there was still strong demand for gold. So there was a huge disconnect that I didn't think in 2015 was sustainable, especially when we saw strong demand for physical gold still.
Absolutely. I think, from a technical perspective, in the gold report, we wrote one chapter that was called "Is the Bull Back?" And I think it's really too important to analyze if something is trading in a bull market or not. And actually, the Dow theory describes 3 different types of trends. So first of all, there's the accumulation phase. The market has just turned up, and well-informed market participants are buying. We have seen that Stanley Druckenmiller, Carl Icahn, Paul Singer, George Soros, and so on. They have recently amassed large gold-related positions, so gold ETFs and especially mining equities. So I think the smart money already started accumulating end of 2015, beginning of 2016, and now we're about to enter the public participation phase. So the media will begin to report on the rise in prices of gold. Many investors that were on the sideline, they are beginning to decide to enter the market. And then, of course, at the very end of the trend, as always, there's a distribution phase. When the interest of the broader public increases, the market is near a peak, there's excessive optimism and so on. But at the moment, I think we're at the beginning of this public participation phase, and you can tell sentiment is getting better. Gold analysts, they are becoming a bit more optimistic. Basically, they're just upgrading their price targets to the recent price level, but I don't see any big upgrades in their targets. This will come, and therefore I think, and we've got that on the title page, on the front page of the report, gold is back.
Yeah, I think gold is nowhere near its 1980 inflation-adjusted high. For it to be that in a dollar from 1980, it would have to be over $2,300 at this point in today's dollar. You wrote in your report about how gold has had the strongest quarterly performance in 30 years. From speaking with other money managers who necessarily aren't gold bugs like you or me, is there an enormous amount of skepticism still from a lot of regular money managers about this rise in gold and gold stocks?
Of course. I mean, I wouldn't call myself a gold bug. I just think it makes sense in this environment, in this huge monetary experiment where central bankers are eager to create inflation, whatever it takes. It just makes sense to be overweight gold. That's basically it. And there will be hopefully a time when we should reduce our gold holdings. Because it would mean that the whole monetary system would be sound and solid again. But that's we're probably pretty far away from that point. And as you've said in my gold report, the long-term target is 2,300 US dollars, which is the inflation adjusted all-time high from 1980. But if you adjust it for the real inflation, according to shadow stats, there would be price targets above $8,000. Now, what I think is really important to understand, we call that anecdotal evidence of three worldviews. So as a money manager, as an analyst, we're meeting quite a lot of market participants, asset managers, fund managers, private bankers, institutional players, etc. So from my point of view, there are three different types of people. They're the believers in the system. They think, okay, we're in a bigger crisis. It's a new normal. Central bankers basically did a great job. Politicians also did a great job. Everything is going to be fine. Then there are the skeptics. This probably is the biggest camp these days. They're a bit more, I would say, pragmatic. So they were buying gold when it was rising, and they sold gold when it was falling again. I think they're basically those market participants that will play a very important role as they are marginal buyers, and they will be driving the future gold price trend. And you can tell that, for example, there's one chart in my report on page 22 showing the total amount of bullion held by ETFs versus the gold price. So gold is rising, and we're seeing also massive inflows into those ETFs. So I think those are typically financial investors that want to gain some gold exposure. And of course, there's the third group, and those are the critics of the system. Once you become an Austrian, you remain an Austrian, and understanding our monetary system, our financial system, how money is created, the effects of inflation, and so on. This is really crucial these days because we're not in a cyclical crisis, we're in a systemic crisis. And I think that the very interesting thing of this observation of those three camps is that it's basically a one-way street into this third camp. So basically, people like you and me being in the third camps, being critics of the system, we will never say, okay, the Fed is doing a tremendous job. Our politicians, they should do another rescue package and so on. It's basically a one-way street. You will never go back. And this also determines people interested in gold. This camp will rise significantly going forward. And I think therefore it's a very comfortable situation that we're in. The media and the mainstream investors, I would say, are only slowly picking up the idea that perhaps it makes sense to hold some gold. And I think this is just the very beginning of this party.
Yeah, I think we're just getting started with the gold bull market rally again. In terms of the system, the crisis being fixed, I think the 2008 crisis was mostly just papered over, with reflating old bubbles, trying to create new asset bubbles and new credit bubbles. And, a lot of the reasons that the 2008 crisis happened, the politicians, the bankers, the government bureaucrats and agencies that were in charge of trying to stop the crisis, they didn't do anything really to actually prevent the next crisis from happening.
Totally agree. I mean, an Austrian approach to really solve the crisis would be laissez-faire. Just do nothing and let the system cleanse itself. I think it's basically what Iceland did. They let the banks collapse, and now they're on a really good way again. We know there were huge rescue packages, and now the whole problem that we are in is much bigger than in 2008. But the big difference is back in 2008, we were able to lower interest rates. So nowadays we're already in very important currency areas, we're having negative rates. People are actually discussing helicopter money. It will be coming sooner or later, probably in Japan first. So I think we're quite in the middle of this monetary lunacy, and it will not end well. And I think the next crisis, of course, will be bigger than the 2008 crisis. And the central banks are basically out of bullets, and we all know that they won't do a laissez-faire approach in the next crisis. We all know that the system is definitely more fragile because the more complex the system is, the less it needs to the system to collapse. So I actually don't know um, where the problems will come from. If it's going to be from China, from Japan, from the real estate market, if it's coming from the European banking sector. I mean, there are so many threats these days. I don't know, but I think that if the crisis happens, it will be bigger than 2008. And of course, if there's going to be quantitative easing part 4, they will have to do, I don't know, 150 billion per month. Due to the falling marginal utility. There might be helicopter money in the US as well. There might be negative rates in the US as well. They will try everything just to prevent this cleansing process that would really be necessary. And from our point of view, we're thinking that a recession is basically around the corner in the US. It might start beginning of 2017, and it's actually a recession is something positive. It's something healthy for an economy. But of course, as soon as the bad R word will come up in the media again, there will be plenty of interventions again.
Yeah, I'm in agreement with that. And I don't think, these central bankers and a lot of politicians, they don't want real deflation to occur. So they don't want asset prices to fall too much without more intervention. They don't want your purchasing power of your fiat currency to increase because governments can't tax it. So there's a bunch of different reasons why governments and central banks don't want real deflation to occur. But us Austrians know that deflation over the long term is good. Savings, investment, prices falling, that's what increases someone's standard of living and allows them to, increase their purchasing power and have a better life.
Totally agree to that, Jason. I mean, deflation is the natural state of an economy in a healthy monetary system, but in a highly levered system, deflation is your worst enemy, and therefore it cannot be accepted. Just to give you one example. For the European Central Bank, they're doing videos. It's actually like animated videos, and they're showing the deflation monster. So little kids should really be scared of deflation because your purchasing power is actually rising and prices are falling. So this is already shows you how far and how crazy that is. But as I've said, deflation cannot be accepted because when you're heavily in debt, you want inflation, of course. And for us, inflation dynamics are probably the most important driver when it comes to gold. And rising inflation rates are the best environment for gold. And we're actually seeing rising inflation rates. We're seeing it in our incrementum inflation signal since March 2016. We're having a very, very strong signal. So we piled into the mining stocks, into energy equities, commodities in general. And due to the base effect, inflation rates will actually start to increase significantly in the next few months. So from my point of view, stagflation will become a major topic in mainstream media. Of course, we're very early on, but I think stagflation that we're already seeing in Brazil, in Russia, and probably in the UK very soon, I think stagflation will happen to the US in the next couple of years as well.
You'll have to email me the link to the deflation monster video. I'm sure my listeners will get a real kick out of that. They'll get a good laugh out of that.
I will. You cannot make this stuff up. It's crazy.
Oh, yeah, well, I mean, they're coming out with economic propaganda with so much of the government statistics like GDP and jobs and unemployment and things like that. So I'm not surprised that they'd make these videos with the deflation monster. None of the stuff these guys do will surprise me anymore. I want to switch gears now and ask you about the Swiss gold refiners. Have you visited any of them lately and spoken to them? We've heard from other sources like Jim Rickards and other people in the gold community who have visited large Swiss gold refiners. They're having trouble sourcing gold in tonnage to recast into 1 kilogram bars that are 4.9s to send to China. Are you hearing the same thing?
Yeah, I'm absolutely hearing the same thing. I visited the largest refineries in Switzerland last year, but also we had a visit this year, also in a huge vault in at the Zurich airport. And I can totally agree. There's so much physical gold coming from London, especially. It's all going to China. I'm also writing about the Shanghai Gold Exchange, which is doing tremendously well, and we all know that it's a physical exchange, that it's denominated in renminbi, and I think we're already pretty far in this process where the dollar as the leading world currency is just losing its status. I mean, that's such developments, they happen over decades, and we're right in the middle of that process. And I think in this big puzzle or big mosaic, the Shanghai Gold Exchange plays a pretty important role.
Do you think the LBMA is running out of physical metal? I had David Jansen on, and he was talking about some of the emergency measures that have been going on with the Bank of England. Do you think then that a lot of that physical metal is being taken out and bought by either China or central banks in Russia and India and things like that?
Yeah, of course. There's quite some issues in the physical market. I don't know actually if the LBMA has any problems at the moment. Because I just didn't have a closer look at that recently. But definitely, I mean, in an environment of rising stress and where people start questioning counterparty risk, of course, you don't want to hold certificates on gold. You want to hold the physical stuff, and that's also what my sources in Liechtenstein and in Switzerland tell me. People are losing trust into our system, and they really want their physical gold out of the banking system, and that's a huge trend, and that's not only that's very sophisticated and ultra high net worth individuals doing that. And of course, for them, physical diversification of their gold holdings is also one huge topic. So they don't have their gold only in Switzerland. They're holding it in, I don't know, in Hong Kong, in Dubai, in Sydney. So they're kind of like a dog is spreading out bones in the garden, so they don't have all on one place anymore.
Yeah, I think diversification of physical gold holdings is important. Companies like Bitgold and Gold Money with a gold-backed debit card, and now
Yeah,
Peter Schiff and all these
yeah.
guys are on board. That makes it easy for, the regular guy on Main Street who's a retail client to get some diversification. Normally, with a lot of these firms, they start charging you a lot of money for insurance and storage fees to move your gold and store it in many different countries.
Totally agree. Yeah, I'm also a big fan of Bitgold. I mean, I know James Turk for so many years. I know Josh Crump. I know Alistair McLeod. It's just a great team, and I think they really got a great business going on. So I can just totally agree.
Yeah, there was actually an article out. I don't know if you saw it from Marco Byrne of Goldcore. He lives in London and he's a London gold dealer. And he was actually saying that there is a problem among London gold bullion banks about moving gold from one bullion bank to another for customer orders because people were requesting that their gold come out of the system. I'll send you the link, the email link later with the article.
Very
Uh,
interesting.
yeah, I want to ask you now about gold stocks since you do hold some gold stocks. How do you research gold stocks? What type of red flags do you look for to avoid in a gold company? Our listeners really want to hear someone who's had success investing in gold stocks.
Well, first of all, I think what differentiates us and our approach when it comes to gold stocks is um, we're analyzing them top down. From my point of view, it doesn't make any sense to be the best stock picker when you're in the middle of a big bear market. And we all know that mining stocks are extremely volatile. I mean, they're up 300%, then down 73%, up 1,000%, down minus 85%. So in this downtrend, uh, um, doesn't make any sense to be a great stock picker, because then you're not down 85%, you're just down 70%, but your clients won't be happy. So we're timing mining stocks top down, and we're really we're writing about gold for 10 years now, and we did a tremendous amount of research regarding gold and gold mining stocks, and we found out that by far the most important driver for mining stocks is the tendency of inflation. So, do we see rising inflation or disinflation? And that's also why we created our inflation model. So, in fact, um, since March, as I said before, for the first time in I think 3 or 4 years already, we're seeing rising inflation rates according to our model. So we're long mining stocks now. Of course, we didn't enter the market at the very low. That's just not possible, and we would be liars if we had said, yeah, we bought the HUY index at 100. We didn't. But I think it's important to say that we avoided the downtrend, this huge collapse in mining stocks. So when you're investing in mining stocks, always have to keep in mind in which direction is inflation heading. That's really an important driver. Um, what else is important? Of course, the crazy thing about bull markets in gold mining stocks is actually the worst companies are doing best when gold is rising. So we're seeing the marginal producers having the highest cost. Of course, they've got the biggest leverage on a rising gold price. So that's definitely important. Of course, political risk is a huge issue these days, as so many governments are basically bankrupt. Yeah, there's quite some interest in increasing taxes on miners, and yeah, basically taking their money. So you really have to be focused on the political risk. It's really important. From my point of view, mining stocks are really in the sweet spot these days, because what we have seen in the last few years in this brutal downtrend is those companies that have survived the past 4 years, they are now resting on a very solid foundation. So there were many efforts to improve operations. The companies are leaner now, their cost structure is better, their balance sheets are more solid. So their leverage, or their leverage on rising gold prices is much higher than back in the days. So I'm also showing one chart with the BGMI index, which is the Barron's Gold Mining Index, and I'm showing bull markets in the Barron's Gold Mining Index, and I can tell you we're right at the beginning of this bull market, and we will have lots of fun in this bull market. There's plenty of money to be made, and the interesting thing is, when I'm talking to really big money managers, institutional players, they all say, gold is already had risen too much. It's overbought. Commitment of traders report doesn't look encouraging. So I will wait for the correction. We had a minor correction in spring, and I asked them, did you buy gold and mining stocks now? I said, no, um, we think this bull market is already over. Gold is dead. So from my point of view, there's so much money on the sidelines. They all have missed the move in gold and mining stocks, but they don't want to buy at those price levels, and that means that there won't be any significant corrections going forward. And this is basically what we're seeing. This is a buy the dip setup. Gold looks extremely strong in so many different currencies. I think, yeah, it's just we're back in the bull market, and we have to ride this bull.
Yeah, I think the gold stocks are set up really nice. The one thing that could really change that is if there's a spike in oil prices, or you mentioned political risk. I think that's very important. I get a lot of listener questions like, are governments going to try to confiscate my gold? Are governments going to try to put a windfall profits tax on owners of gold or gold miners? Are governments going to try to nationalize gold and silver miners? We don't know what the future holds. We can put probabilities on these things, but obviously some of these governments, whether it's Ecuador or others, have histories of potentially nationalizing gold mines. We just don't know. So I think, obviously some diversification in the gold space is very key.
Absolutely, totally agree. I mean, one country that I'm following quite closely these days is Argentina. It's really getting better. I wouldn't invest in Venezuela these days. But yeah, as you've said, diversification is key. That's basically the only free lunch on the market that you can have. And I think with all those political risks, financial repression, and so on, it's really key to make your due diligence, take your time, analyze the stocks, analyze the risks, and then, as I've said, just ride the bull.
Now, Ronald, if our listeners want to go get the report In Gold We Trust, how did they do so? And if they're interested in becoming one of your clients, how do they contact you?
Well, the report is totally for free. You can download it on our webpage, incrementum.li. It's just Google it, In Gold We Trust 2016. It's all over the web. There's one version, the extended version, or the triple X version, as we also call it. It's 140 pages, but there's also one more compact version for readers who don't have too much time to study such a thick report. So the compact version is only 20 pages. It's also available on our webpage. And yeah, on our webpage, of course, there's also plenty of information regarding our funds and our services. And otherwise, you can just drop me a mail. My contact details are on the webpage, of course.
Great. Well, I want to thank you for your time. And in a land of $12 trillion of negative interest rates, gold looks even better the more there is negative interest rates and the more countries that start doing them.
Absolutely. Thank you very much, Jason. It's been a pleasure.